Good afternoon, everyone. Future here. I want to show you four unrelated stocks that have the same pattern that are helping me determine where we are in terms of the current price structure, in terms of the pattern, in order to get a grasp as to where we're headed in the broader stock market. Okay, so let's start with the IWM. This is the Russell 2000 ETF that tracks the small cap index. And so in the previous video, I covered the IWM somewhat extensively. I pointed to this target, 94.60, because this is the 50% retracement level of the rally from the 2011 lows. Let me just show you that really quickly. Okay, so this is a simple fib study here from the 2011 low because I do currently I do still think this is potentially a third wave, and this is a fourth wave that should be completing soon, if we are still in a bull market. Okay, and so that study is a simple fib retracement. So we'll draw out the length of this proposed wave 3, 1, 2, 3, 4, and 5. Okay, you can see the 50% retracement comes in at 94.60. And yesterday's low happened to be 95.06, so a few points just shy of it. But you could say virtually the 50% level has been tested, and I do not think this is a low, even considering that we've had such a massive rally in the past day, a reversal, I should say. Because yesterday's decline was somewhat nasty. So what I believe is underway. This is an A, B, C wave structure. Let me just put that in here real quick for my own chart. Okay, C waves are always 5 waves. So this bounce here is a fourth wave rally, or should be a fourth wave rally. So let's identify resistance that may provide a stopping point for this fourth wave. So let's just turn to Fibonacci for this study. So the very first thing I want to do is I want to look at the Fibonacci retracement levels of wave 3. Okay, since wave 4 corrects wave 3, they are related, usually by the 38 to between the 38% and the 50% retracement levels. So let's put that in there. Okay, so that is a straight Fibonacci retracement study. The next thing I want to do is many times the corrections within an impulse wave, that being waves 2 and 4, are related by price and time. So we'll focus on the price part of that equation, and we'll take our trend-based fib extension. We'll draw out the length of wave 2 and project that higher from the termination point of wave 3. Okay, conveniently, 200%, the length of wave 2 projected from wave 3 coincides exactly with the 50% level. Okay, but let's draw some other common stopping points. The 100% level we've already reached, and I do think that yesterday's price reversal and today's marginal, I don't want to call this a rally, but this small gain here is too short, so we're going to get rid of the 100%. Let's go over to the next fib level, which is the 138. And the 1272. Okay, so this is proving to be a little bit of a zone here, anywhere between 101.50 and 102.81. So this would be an ideal stopping point for wave 4. It can go higher towards a 200% fib extension projection of wave 2, and where the 50% Fibonacci retracement of wave 3. This also coincides with a potential retest of this broken trend line, which is somewhat of a very important trend line, which is one of the major cases that that the major bull market is finally broken. Okay, so but many times we don't just continue lower. There is a retest. Sometimes it's called a final kiss before the goodbye, whatever you will. But either way, this is proving to be textbook for a continued rally here, very likely in a wave 4. Now, before we drop lower in wave 5 to complete a potential A, B, C correction, from there, it is possible to turn bullish. You could turn bullish now, but I want to see confirming price action, and a one-day reversal is not confirming price action. Okay, it is a signal to be on the lookout for confirming price action. From an Elliotian perspective, my confirmation is a small 5-wave rally. Okay, until I see that, I'm going to continue to have a bearish bias. Now, this is the IWM. Now, let's turn over to Apple. Okay, so this is the all-time high over here. Okay, and similar, and by the way, this low here is the August 24 low. So this decline here is wave A. We then had a 3-wave rally in wave B. And once again, just like the IWM, wave C is underway, and wave C should be impulsive. Okay, so what's happening here is this is wave 1. We have a 3-wave rally in wave 2 as expected. And then we have a 3rd wave decline, which subdivides into its own 5 waves. Okay, so currently the way that counts is this is wave 1, 2, and 3. Okay, so if we do the same study real quick, I think a 50% retracement of wave 3 would probably be too deep. We know that Apple has fallen out of favor with investors some, so we'll expect a more shallow retracement. Yeah, the moving averages are not even in the area um, of this Fibonacci resistance zone. So I will look for the area between 102 and 105 to serve as resistance. If for some reason the moving averages, if wave 4, if the function of wave 4 is to buy time, then this 50-day moving average in red here is going to continue its trend lower and then potentially be a compounding source of resistance here. So yeah, I won't add much more to that. Let me get rid of these averages. So we're going to put a proposed wave 4 somewhere in here before we move lower in wave 5. Okay, to complete a larger A, B, C. Once wave 5 is underway, we're going to do a different set of Fibonacci studies, which include equality between waves A and C and other Fibonacci relationships, but once again, one step at a time. So that we've covered IWM and Apple. Take a look at Goldman Sachs. Goldman Sachs has been the canary in the coal mine for me for quite some time. Late last year, I stated that this was an impulse wave to the downside, which terminated um, in September 29. This was a wave 1, 2, 3, 4, and 5. Even wave 5 has its own subdivisions, which is really nice. This is an impulse wave. This is 5 waves. In terms of corrections, Elliott wave tells us that there is only one corrective pattern that starts where wave A starts with 5 waves. That is the zigzag. It has an internal count of 5, 3, 5. Okay, so this is the first 5. This is the 3, and then we need another 5 wave sequence here. Goldman Sachs, being a financial, we know financials are taking a major hit, has a series of 1s and 2s here coiled up to the downside. So this certainly has lower to go. I do believe any rally here is an opportunity to either liquidate or to enter short. Okay, but in general, and if you don't want to take directional trades, I do believe in this environment, call credit spreads, you know, put spreads really is the best strategy moving forward until this decline is over. Perhaps in financials, it may be more beneficial to have more directional trades, because we're not only are we trading below August 24 lows, we're trading below September lows here. So, but anyways, giving you the Elliott wave count, this is wave 1, as in 1, 2, 3, 4, 5 to complete wave 1. This is a larger wave 2. We then have a smaller degree wave 1 and 2. Okay, so this is significantly more bearish than Apple or even the IWM. Then we have a 1, 2, 3, 4, and 5. So this completes wave 3. And if Goldman Sachs is going to rally along with the broader market, then we should see a bounce into wave 4. I'm not going to do the Fibonacci studies, but this should be, a small bounce would be welcome here in order to maintain this roadmap alive. We can then expect wave 3 to bottom out. Potentially the rest of the market bottoms out once we have a third wave structure where Goldman Sachs would languish in a wave 4 and continue to make new lows in a wave 5. What we want to see is ultimately is equality between waves A and C. Okay, so there is a lot of work to be done in the coming months here in Goldman Sachs. This is one I definitely do not recommend to the upside. Okay, if anything, this is accelerating lower. Okay, so we've covered the IWM, Apple, Goldman Sachs, and let's take a look at oil. ConocoPhillips. In fact, this is one of my favorite stocks in terms of, I think, quality. But this is, this is unfortunately no longer, excuse me, as long as oil continues to go lower, this is, stay away from this. But this is one I wouldn't particularly short. But let's take a look at the Elliott wave count. So from this swing high here, we have a wave 1, 2. Then we have a small 5-wave structure. So this is wave 1, 2, 3, 4, and 5. So from this top, we have a 5-wave structure. So this is wave 1. Small bounce in wave 2. And then take a look at the acceleration. Okay. This accelerated decline has the personality of a third wave. This is what third waves look like. Okay, so if you had counted this in real time, you would know that any rally should be sold. This is where you make your money. Third waves are what you want to ride, either to the upside or to the downside. If you're not actively short and you're counting this in real time, at the very least, you know this is not a buying opportunity. So sometimes, I get comments that are, um, it's comments that state that we should be buying whenever we see a completed impulse wave. That is not the correct stance. That is not what Elliott wave teaches us. What Elliott wave shows us is that if you can count a 5-wave decline, yes, you're supposed to expect a 3-wave or a relief rally to some degree, but the impulse wave, in this case down, is telling us that the trend continues to remain down. Okay, so going long here for this potential gain here certainly outweigh the risk. And in this case, we would have been wrong, and we would have been wrong in the face of a third wave. So follow the impulse waves. Follow the trend. Okay, more often than not, if there's a surprise, it's going to go in your favor so long as you're following, you're trading in the direction that the impulse waves are unfolding. So this is a third wave here. I'm expecting a fourth wave bounce so long as oil can rally a little bit more and equities can continue to move a little bit higher in the coming days. It's Thursday. If we close the week now the way it is or slightly higher, it's going to leave a somewhat of a bullish mark for and give the following week somewhat of a bullish bias. So this would be a good area here to expect a fourth wave. So, and then we can go lower in wave 5. This is in line with continued oil pressure. You guys have seen by now the longer term targets that I have for oil in the area of 26 and 23, okay, and even down to 19. So I don't think we're out of the woods yet. I don't think we have a lasting bottom in oil, and I don't think we have a lasting bottom in equities. This is simply an oversold decline. And so we should have a rally as is normal. So that's it for now. We've covered IWM, Apple, Goldman Sachs, and ConocoPhillips. So that's it, guys. If you guys have any questions, please leave a comment below, send me an email, or reach me on Twitter at FutureMeDead. Best of luck.